All right, this is Ubaid on behalf of Electronics, and in this video, we'll be looking at the third way that the central bank uses to execute a monetary policy. So we've talked about your open market policy, your open market transaction, which has to do with buying and selling of treasury bonds. We've also talked about the discount rates, which has to do with the interest rates charged by the central bank, okay, to commercial banks or for the commercial banks to borrow money, okay, to um, prevent insolvency and bankruptcy, for example. Now, this is during a bank run. This is when the customers might be withdrawing their money from the bank because they think the bank might go bankrupt in the future. Okay, now in this video, we'll talk about reserve requirements. So when it comes to your reserve requirements, we're talking about the required reserves. Okay, this is required reserves that the bank or commercial banks in general are required to keep as part of law. So they're legally required to keep a certain amount of reserves on the side. Okay, so required reserves, and this has to do with their financial stability, okay, your financial health, so on and so forth. Okay, now the required reserve could be as much or as little as 10% of the total deposits, okay, of total deposits. Okay, and this could be for things such as withdrawals, where customers may need to withdraw money from the bank, as a result of which the bank may have enough money under their required reserves in the vault, okay, for the clients to withdraw. All right, now, as per the monetary policy, okay, to execute a monetary policy, the central bank or the Federal Reserve Bank may change the percentage of this required reserves. Okay, so may change percentage, may change percentage requirements, percentage requirements of required reserves. Okay, so basically the Federal Reserve Bank may go ahead and bump up the percentage requirements. If this is 10%, this could become 15%, for example. Okay, now if they raise the required reserves, okay, if this goes up to 15%, what's going to end up happening is the central bank, okay, will basically execute a monetary policy. All right. Because when the reserves go up, the required reserves go up, the commercial banks can lend less, okay, because obviously they have to keep a certain amount of their deposits, a certain amount of their reserves, okay, in their banks. Okay, so commercial banks, they lend less money, lend less. All right, and when they lend less, obviously the spending goes down. Okay, because the money they're lending to businesses and individuals. All right, so personal consumption and capital investment goes down. And we know that personal consumption and capital investment has to do with aggregate demand and real GDP. So if personal consumption and capital expenditure goes down, the aggregate demand and real GDP will go down. So our GDP goes down, which basically constricts the economy, contracts the economy, as a result of which you have economic shrinkage rather than growth. Okay, this is all because the reserve requirements, the required reserves went up. Okay, so this is economic contraction because of lack of personal consumption and capital investment. All right, and if they reduce the required reserves, if they reduce the required reserves, The bank may lend more money. The commercial banks, they may lend out more money. So commercial banks, they lend more money, lend more. And because they lend more money, the spending goes up, real GDP goes up, and you have an economic expansion. However, this economic expansion comes with a price. Okay, when the commercial banks they lend more money, they have less in their reserves. Okay, it basically means that the clients are not able to withdraw their money from the banks. Okay, as a result of which, it's possible that the bank may forecast a bankruptcy sometime in the future. Okay, because if the clients are not able to withdraw money, okay, they might go for a bank run. Okay, they might withdraw their cash whenever they get the opportunity and never deposit back again. All right, which means they're done with the bank. They might choose another bank if this happens every once in a while. All right. Now, apart from that, we know that the 2007 and 2008 recession had to do with the subprime mortgages because the homeowners weren't able to afford the mortgages because of stagnant economy. They weren't able to pay the mortgage loan. Okay, as a result of which, if the banks lend out more money because the required reserves is less in terms of percentage, okay, it's possible that they may risk unforeseen events. They may risk losing that money because of foreclosures, because of okay home foreclosures. They may risk uncollectible accounts. Okay, they may risk bad debt, so bad debt expense. Okay, they may risk the customers or the clients not being able to pay their money on time. Okay, and this all leads to a recession, as we've seen in the 2007 2008 recession, where the investors worldwide who invested in subprime mortgages didn't receive their money, either didn't receive their money or didn't receive that money on time. So it leads to a recession. All right, so that would be it for this video. On behalf of Electronics, this is Obaid. Have yourself a great day.